Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Well, welcome back to the Emerging Managers Podcast. My name is Scott Kelly. I'm the founder and CEO of Black Dog Venture Partners and your host. And I'm really excited today to introduce you to Dan, Laboe, and KP, the team at Nymbl Ventures. I got to meet them at the Blueprint Conference in Las Vegas, as I mentioned in a prior podcast, a great conference and summit focusing on the prop tech, construction tech, and related industries. And, the interview, they're talking about the built environment. And, Nymbl is raising their first fund, an alpha fund of $50 million, and they're going to focus on technology-related construction, including advanced materials, robotics, advanced manufacturing techniques, and automation. They invest in companies beyond the prototype stage, preferably revenue positive, with about $500,000 in revenue, and they're typically looking for Series A or later investments. The firm has a unique hybrid model, which brings corporations and financial investors together, enabling these corporations to invest in a venture capital fund while maintaining the flexibility of their own corporate venture capital arm. What this does in the construction industry is provide not only the opportunity to get good investors from a financial standpoint, but get strategic corporate investors from the construction and property and real estate business. So it really provides a really good mix for entrepreneurs to get not only great investment capital, but great opportunities to grow and scale their business through strategic partnerships and strategic investors. So let's give this a listen, and I'll share some key takeaways at the end. Well, hello, everybody. Scott Kelly, founder, CEO of Black Dog Venture Partners, and your host for the Emerging Managers Podcast. And I'm excited to introduce the team. This is actually only the second time I've had two guests simultaneously on the podcast. So I've got the team from Nymbl Ventures. Dan, Prabhakar, welcome to the show.
Thanks, Scott.
Thanks for having us.
Well, why don't we do this? I'll let you gentlemen pick who does what, or you can both jump in. Maybe both of you can share a bit about your backgrounds prior to the fund, and then we'll jump into the fund itself.
Excellent. I'll go first if you don't mind, Dan. So Prabhakar Karri, I go by KP. Those are my initials. Everybody's called me KP ever since I was in kindergarten, so feel free to call me KP. Dan and I started Nymbl Ventures about a year ago. And prior to Nymbl Ventures, I started and led Anderson Corporation Ventures, which is the CVC arm of the Anderson Corporation, based here in the Twin Cities, Minneapolis. Prior to that, I ran a small startup called Nymbl Technologies, no relation to Nymbl Ventures, which was a fitness analytics software company, which unfortunately died a miserable death during COVID because all our clients were personal fitness trainers and their business evaporated, unfortunately. Prior to that, I ran a CVC called Prime Therapeutics Ventures. Prime Therapeutics is a wholly owned subsidiary of several Blue Cross Blue Shields. I was focused on emerging healthcare technologies during that. And going back even from there, I was an investment banker with Lazard, focused on mergers and acquisitions, and I have a background in technology and physics. So that's me.
Thanks, KP. Dan, share a bit about yourself.
Yeah, so I've kind of had a unique background. I can start kind of from the beginning, starting with moving to Chicago, doing prop trading. So I traded derivatives of interest rates, euro dollars, if anybody's familiar with it. So started there. I did that for a bit. Unfortunately, the company exploded within, I think it was a year of me joining. But, it gave me a good knowledge of really what the drivers of the economy are. Interest rates obviously underlying a lot of different asset classes, and understanding, where that market is really, headed in the long term is where the economy's at. So coming from that, I ended up going to corporate finance for a bit with a Fortune 50 company, kind of showing me the inefficiencies of a large corporation and kind of where some of those opportunities are, which led me to my next role, which is at Zacks Investment Research, where I was a sell-side analyst. I focused on the industrial space, looking at Industry 4.0, everything from semiconductors, advanced manufacturing to, IoT and AI-enabled solutions. And then from there, I wanted to go to the private sector, look a little more towards VC. I worked at a company called Built Worlds and established their venture and investment team. So what I did there is kind of built a consortium of over 30 different CVCs, innovation teams within the built environment, helping them out with deal flow, understanding the market trends, and ultimately, where the investment dollars are going and kind of where those investments can help some of their pain points. So working with them closely, that's where I met KP, who was at Anderson Windows and Doors at the time. And, we came up with an idea of, maybe a better model for investing in this space that leverages corporates. And, we'll talk a little bit more about that in a moment. But that's my background in a nutshell.
Fantastic. Yeah, let's jump into the fund, Nymbl Ventures. Talk a little bit about your fund's thesis, where you're investing, how you're investing, what stage, check size. Just give us an overview of the fund itself.
Excellent. Thank you. So we are raising our first fund called the Alpha Fund. It's going to be a $50 million fund. And we are focused on the built environment. And by that, we mean anything and everything technology related to construction, whether it's residential, commercial, or industrial, right from the planning stage to, breaking ground, execution, development, and maintenance and managing facilities. We like to focus on technologies that play in the space, including advanced materials, robotics, advanced manufacturing techniques, and automation. There's a lot of automation that's going on in this field. In terms of investment stage, we like to invest in the built environment. Going back a little bit, the built environment is pretty unique. I mean, investors traditionally, the players in the industry are very conservative. Lead times are very long. Development cycles are pretty long. And so any average startup that tries to break into the space has a pretty long initial ramp up period. And so we like to invest in companies that are beyond the prototype stage, preferably revenue positive. In fact, we'd like to look for some revenues like about $500,000 or so. We like to invest in companies that are trying to raise Series A or thereabouts. Recently talked with the company and that we're doing due diligence on that's never raised money, but they don't know what to call it. But it's going to be a Series A. I mean, they have lots of traction. So we like Series A plus or minus, right? And then in terms of our model, we like to bring corporations and financial investors together. And there's a real reason. There's lots of reasons for that. The primary one being that success in this space for startups is predicated on support from incumbents. And that's larger corporations that play in the space, plus, the financial input that comes from VCs. So we have a very interesting and a unique investment model called the hybrid investment model that's geared towards corporations, which enables them to invest in a VC fund, but at the same time have the full flexibility of having their own CVC that they would normally typically have. So that's our model. We can talk about it a little bit more. In terms of check size, we also realize that companies in this space, especially those focused on hard tech, need a lot of capital and a lot of runway. So our check size is typically between $1 and $3 million. Our sweet spot will be like 2.5. We prefer not to lead rounds, but we are happy to lead rounds. And the reason for that being, we like to match every startup that we invest in with a corporate captain. And so we'd like, so that the corporation brings a lot of know-how and expertise to the table. Anything else? I mean, that's covered.
No, I appreciate that, KP. So Dan, you and I got the chance to meet at Blueprint. And, honestly, it was the first time I'd gone to that conference. And quite frankly, I went there because I had two portfolio companies that were less than a month old that I wanted to bring with me, and I found out about it. So maybe Dan, you could share, specifically Blueprint, but where you see, where the growth has been in this prop tech, construction tech industry over the last, several years.
So I would say, looking back at the data, I guess I'll highlight this. We track over 1,600 startups actively in the built environment across over 3,500 deals. We're looking at over 5,000 investors, probably more than 500 M&A deals. So, what I've seen recently is obviously a big move towards AI. This year so far, we've had over 60% of the investments in the built environment go towards this. Robotics is another one. This is probably making up about 40%. And I think a lot of this has to do with the fact, robotics specifically, there's a lot of manual, simple tasks that are repetitive and easily replaced by something like a robot, such as loading and unloading a truck, maybe a safety precaution such as placing a window onto a high rise, or, a number of other solutions that are applicable in that sense. We obviously saw things like Field AI come out, the robotic dog that's taking the whole, call it, layout of a building and progress tracking different construction sites. That's an interesting solution. I think it's a little bit complicated for right now, I will say that, just because of the fact that job sites are still dirty. Having a robot that's fully metal running around a job site while people are on it can technically be a little bit more dangerous and cause that, call it, apprehension that a lot of these GCs and business unit leads are having about technology. But I think ultimately, we're seeing a lot of investment into IoT. So just getting that data tracked, getting that data in the right place, so data management systems as well, in order to fully leverage the capabilities of AI. And I think we're really seeing it from the beginning life cycle of the project all the way through. So understanding the data from the planning, origination, and the takeoff phase and pre-construction phase, all the way through to construction, I think will allow an AI technology to fully understand the decision-making process throughout the life cycle and come up with more effective decision-making in a real-time scenario. And I think ERP systems are going to be big too. We're seeing more and more point solutions slowly but surely come into a call it a full circle of or a full suite of solutions that really make up a company's ERP. And a lot of GCs out there do not have ERP systems in place today. So I think having new ERPs that are AI ready are going to be critical to really implementing AI into this space in the next, call it 5 years. So I think AI is going to continue to see a lot of investment in the next few years, but it's going to have to be paired with a lot of these IoT and data management solutions in order for these to effectively, provide those predictive, predictive solutions and predictive outcomes, if you will.
So KP, obviously, Dan mentioned AI, and that's obviously very prevalent. It is the vast majority of investments in venture capital now. But let's talk about outside of AI. What are some of the attributes of the founders that you're potentially investing in? Who are these people, or who should these people be?
So when we're looking at investing in the built environment, right? Like Dan alluded to, there's a lot of solutions that are software based. And so the founders of software companies are typically, usual, what we've seen in the past, like, young, maybe first-time entrepreneurs, maybe successful and second-time entrepreneurs who have built a solution, taken it to market, exited, and are looking at a different solution. But beyond that, right? So the built environment is more gray hair than anything, right? So, and some of the larger corporations that we've experienced and we worked with and have worked at have very deep R&D teams that have very long institutional knowledge, right? And so many of the innovations in the built environment are not likely to be overnight successes. They can be like, aha, I just kind of came up with this new formula, especially when it comes to advanced materials or robotics or things like this. These are incremental long lead cycle development technologies. And so an attribute that we like to see is somebody who has obviously basic education in sciences, right? Understands some of the stuff that goes into this, but also has been around for longer than maybe 5 or 7 years, right? Who's seen the ups and downs of the cycles. Construction, as you know, is again can be a start and stop environment where projects can get out to a great start and then slow down and then pick up again. And so somebody who's been through those cycles. So I'd say an ideal entrepreneur in this who would be somebody in their late 20s, early 30s versus like, teenager or young, I'm not saying that you can be a teenager, but but it's somebody who's been around the industry for a little while, who understands ups and downs and also has the long-term perspective and understands that it can't be startup today, Series A in 6 months, Series B in 12 months, and exit in 36. That's probably not going to happen.
So let's talk a little bit about, a little bit more feedback on the current makeup of what you've done before. Maybe share some success stories of some companies doing some great things in the industry that you've been involved in, or great companies that you're looking at today. And Dan or KP, I'll let you either you take that one.
Yeah, we're from Nymbl's Alpha Fund. We haven't invested, and we don't have an exit. So going back into the history books, I can talk about some of the materials companies that we've invested in.
Okay.
Lots of and this is also within the U.S. By the way, part of our thesis is we are North America focused primarily.
Okay.
Because our team is all based here, our experiences here, and then we definitely are open to investing or co-investing with European startups. But that's our sweet spot. So in the United States, North America, a lot of materials technology companies have been coming up. especially in the Michigan State has lots of innovation accelerator programs, the state itself.
Okay.
And so we looked at some very interesting glass technologies for construction. So windows and doors tend to be the highest carbon footprint components of any building, right? I mean, whether it's industrial construction or commercial residential. And so we were seeing some really good technologies over there. We're seeing a lot of good technologies in composites. For instance, traditionally, most residential construction and some light commercial construction has been wood frame, right? And as more and more people are getting sensitive about the impact, the carbon footprints and impact of those cutting down trees, there's been an emphasis on alternative materials, and we've seen some really good alternative materials. So I don't want to name names because that would probably kind of tilt the thing. So that's the second thing. And the third thing is clean tech. I mean, clean tech is big. I think you probably heard of Nymbl. I mean, they have this conference a couple of times a year. It's been on for a long time, but it's right now it's kind of catching the cadence in terms of good materials, good technologies to the front. That's basically where I think we're seeing a lot of beyond AI, right? But then going back to our success stories, what I'd like to kind of is one of the differentiators we have is our data, like Dan mentioned. And so maybe Dan, you want to give some highlights about what insights we have from our data that actually are very useful for investors.
Yeah. From our data set, like I said earlier, we're tracking over 1,600 startups across over 3,500 deals. We're really finding that corporates coming in at the right time and the right level has provided a boost for a lot of these companies. I think CVCs came in a little bit too early in the past, pre-seed, seed, and pushing a lot of these solutions onto their business units and GCs. And obviously, with 3% margins being a good project, that's a plus project, you don't have much margin to flip that. So a solution that comes in and causes more problems than it solves could easily shift that to negative quickly. And I think that was a problem we saw in the early 2020s as these CVCs just started popping up. A lot of these players came from the innovation side and they didn't qualify and quantify the benefits and risks of these solutions early on. And I think, right now we're seeing this shift in the built environment, and this, data backs this. 80% of the investments made in this past quarter in Q3 were towards Series B and later. And I think this is a broader shift in where the emerging, call it setup, this emerging ecosystem is headed. Prior years, 2024, we only saw 60%, 2023 was only 50%. And that's just because these technologies were not ready. And going back to what I was talking about, putting these solutions on the job site too early, it caused a little bit of trepidation among the broader ecosystem to even adopt anything. If these were commercial ready, identified as commercial ready by the CVC, and they didn't actually provide that commercial ready benefit, I think that is causing some of the, call it legacy players, to be apprehensive to adopt this technology. So being able to quantify and qualify this to the end user is going to be really beneficial moving forward. And I think these startups are finally coming out with solutions that can immediately provide value. And that's kind of where we're focusing in. We're focusing on solutions, like I said, arbitrarily Series A. We want companies that are substantiated by the broader industry, that have been on many projects that aren't being customized for these different, singular companies. And I think we're seeing more and more, CVCs realize this, mostly focused now in the Series A segment and later. So I think that's coming more and more. We're seeing that bootstrapping has been successful or has created more successful startups in the long run. Bootstrapping into your late seed or Series A, because this obviously instills a sense of lean operations, which is critical for this space. You back at the data, you see that the construction tech space compared to prop tech and infrastructure tech has about 2 to 4 months additional, call it runway, for each fundraising round, for each subsequent fundraising round. So it's, obviously project-based, taking more time. And lean operations, I think, are going to be key for a lot of these startups to not only remain buoyant, but to really drive success. And we want to invest in companies that don't need capital, but would like it to scale. Obviously a pathway towards free cash flow positivity or free cash flow neutrality in the next 12 to 18 months is something that I think is unique to this space, because that's almost a necessity for these players to really survive. and ultimately.
So let's talk to listeners today that are potential investors, LPs, wealth managers, managing money and investing their clients' money in alternatives. So what's the makeup of the current investors that you've approached or you have in the fund now and the investment partners that you're going to be partnering with? KP?
So we made very early on, when we sat down and made our investment thesis, we'd like our fund to consist of half strategic investors and half financial investors. And when we say strategic investors, we mean leading corporations that span the entire built environment spectrum. And so the reason for that is, like I mentioned earlier, startups in the space can have a pretty good core technology, but construction and built environment has other challenges to solve, such as codes and logistics and things like that. That startups shouldn't be spending, in our belief, spending too much time on. And so having that corporate support, somebody who's been there, done that, knows, and maybe plays in 50 states or maybe 30 states or whatever it is, right? I mean, Southeast, Southwest, who has domain expertise beyond just the technology and the lab. That's very important. Taking the product to the market is a very important skill, and it's very expensive. And so that's why we like LPs who have both the experience and the capital.
Mhm.
On the financial investor side, we like LPs who have some investments in the real estate, and most financial investors tend to invest in real estate, and who appreciate the, like Dan mentioned, 50 basis points of incremental margin improvement from technologies, right? And it can be pretty big to the bottom line. So we like financial LPs who have exposure and knowledge of, the environment, and who would like to invest in emerging technologies, but who also understand some of the long lead times and time to profitability that comes with this environment. That's our goal. Our goal is to have 50% of our capital come from corporations and 50% from financial LPs.
Great. And Dan and KP, both of you can answer this question. I always like to ask this question for listeners today that are considering making an investment in a fund, and specifically your fund. So the question I'd love to ask everybody on this show is that, why your fund? Why now?
Yeah, Dan, you want to take that?
Yeah, I could take this one. So, we are a first time fund. I mean, we have had CVC experience, but we are going to be very active in working with our LPs. We'll pick up the phone, we'll provide you with not only a deal flow, but have those conversations about what deals you're interested in. Ultimately, we want our corporate LPs, like KP said earlier, to be the captains of our deals. So our corporate LPs will not only lower the risk for the financial investors, but will provide these startups with a platform to not only be a customer, but really grow and get into these channels. And, we want our active LPs, whether it's corporate or financial, depending on how active they want to be, to have a seat at our advisory table, right? So we want them to be, discussing ideas, discussing the investments that they're looking at and they're interested in. Obviously, we're providing that deal flow, but ultimately we want our corporates to be the ones driving those decisions. Our proprietary database really, I think, allows us to stand out in the sense that we're quantifying the unquantifiable of the built environment, specifically the VC part of it, and synthesizing the data into something that can be valuable, really understanding the drivers of success in this space, and ultimately, what's going to result in a strong exit. We talked about the hybrid investment model, I think is really attractive for our corporate investors and gives them a little bit more, call it oomph in the sense of, we can get our hands dirty and get involved in this investment vehicle. I guess KP, I got one more thing I would add is the space. Like I said earlier, we're seeing a shift in the space towards later stage investments. We see it in seed, plagued this space for, call it 10 years, starting in 2015 to call it the last 2 years. But I think right now we're seeing this next boost in investment, and it's being driven by adoption. I mean, the adoption is going beyond ENR 5 or 400 right now. It's going to smaller players. We're seeing a big jump in trades and subcontractor solutions. So, I think it's really hitting every part of the built environment, and a lot of opportunity for upside potential here. And I think the ROI is really the strongest it's ever been for the space right now.
Awesome. KP, anything to add?
Yeah. That's a great segue. This built environment as a VC investment class is coming of age. That's what we believe in. We've seen this for the last, like Dan said, 10 years or so. People who got in pre of COVID or just after COVID, I mean, there was actually a gold rush, and then you know how that ended. 22 was a pretty bad year for VCs, 22, 23. But I think we believe it's a confluence of the underlying technologies, internet connectivity, AI, cloud, whatever you want to call it. Some of those earlier technologies that have attracted VC investments and are mature beyond the, fintech. Payments processing for small contractors is a big deal now. So all those problems have been solved. Obviously, healthcare is a separate, complete beast, and AI, encompasses everything. But beyond all that, the built environment is coming of age. And so this is a good time. Some of the secular trends Dan alluded to, I think, after 22, 23, having kind of people have been sitting on the sidelines and not making a lot of investments. The exit environment is improving right now. I mean, this year we'll have more IPOs than we've had in 2024. And so investors are kind of waiting for that. And so so we're now at the what I would say up and down cycle. We're kind of pretty much at the bottom of the down cycle from a VC perspective, right? I mean, I won't comment on the broader economy. And we also look like the maxim internally. If the market is down, buy low, right? And so I mean, even if the market kind of goes down, it will only be to the VCs and investors' benefit because better terms and getting in at the right time. About Nymbl Ventures, one other thing that we need to mention is our team. So there's 4 of us. You met Dan and me. There's 2 of us, 2 other folks. Between the 4 of us, we have over 30 years of CVC experience. We have hands-on industry experience in the built environment, built different technologies. We have lots of deep financial management and analysis and investment experience. A couple of us have Wall Street experience, and we work on Wall Street. And 2 of us have advanced technology degrees. So when we look at startups, we are looking at it not just from just the technology perspective or just the market potential or just the industry. This team can look at it from all the angles. And I'm the oldest guy in the team. So the team is pretty young, pretty energetic. We pick up the phone and like we said, we like to keep our LP base small. We like to keep our number of investments small. We'd like to make more higher conviction investments than, like a spray and pray kind of an approach. We don't like that approach. So we will pick up the phone, we'll answer calls. And we like active investors. I mean, I'm not saying we won't take money from passive investors. We will be happy to help them and invest on their behalf. But active investors, we like to have a dialogue, understand what's going on in the industry.
Where can folks learn more about Nymbl Ventures and get in contact with you gentlemen?
Yeah, I mean, the website is the obvious spot. I mean, it's pretty sparse. We have a section that's sectioned out for our LPs. That's off limits for most of normal folks. We actually publish a lot of pretty insightful publications. We do a quarterly industry report. We do an annual report. And as you probably surmise, we're pretty data geeks, right? I mean, we go deep into the data, and try to look for insights that are second degree, third degree level. So if you'd like to get on our distribution list, reach out to us, go to the website. Our contact information is right there. And we can happy to have a chat with you in terms of how we can help you along in your investment journey.
Great. And Dan, how can I get in contact with you? You seem to have a lot of data, a lot of insight. Get us the exact URL of Nymbl Ventures.
Nymbl is spelled with a Y and an L. So www.nymbl.ventures.com. Nymbl.com. My email is pkarri, Pkarri @nymblventures.com. Dan's email is dlaboe, DLABOE @nymblventures.com.
Fantastic. Whoever listening, on future podcasts, we're going to be spending some more time in this space. I've had a couple interviews and I got a chance to meet Martin at Blueprint. He's going to be on our podcast very soon. And so I encourage everyone to keep track of what Nymbl Ventures is up to. Like, comment, and share this podcast. And Dan and KP, thanks for being on the show today.
Awesome, Scott. Thank you so much.
Thanks, Scott.
Welcome back. When I was speaking to Dan and KP at Nymbl Ventures, I was really intrigued by their hybrid investment model that I mentioned in the beginning, where they're attracting corporate investors and financial investors, leveraging corporate expertise and financial capital. And this provides a unique opportunity to get some of these large corporations that might be in the industry, in construction or real estate or architecture related industries, the opportunity to invest in the technology that they may want to use in the future. And so this provides founders a unique opportunity to get involved with investors and strategic partners to help accelerate growth in the investments. But the thing that founders need to understand is that success in this space requires support from these incumbent corporations due to the challenges like codes and logistics, which Nymbl Ventures' hybrid model aims to facilitate. Their experience provides them an ability to get these founders involved and not only get the money they need, but get the expertise and the connections they require. And they, in both KP and Dan, believe that bootstrapping in the early stages, in the late seed or Series A, is seen as beneficial. It instills a sense of lean operations, which are critical for survival and success in this space. And Nymbl has a unique ability to help these companies get that scalability, allow them to be more bootstrap oriented with less capital early on, and then additional capital as they succeed. So what I'd encourage you to do is take a look at what's happening in this space. I was really intrigued, as I mentioned before, when I was at the Blueprint Conference in Las Vegas, and it was really intriguing to meet Dan and KP because they have not only great financial experience and a great model to invest in these companies, they have great relationships and connections in the industry that provides these companies that are being invested in the opportunity to get the connections they need, and these corporate investors to get access to leading technology to help their core companies. So again, I encourage you to listen to this podcast. Again, like, comment, and share, and I'll see you soon on the Emerging Managers Podcast.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.